GameStop is currently up 70% today after Roaring Kitty, which was the original user for Reddit that really called out the short squeeze on GameStop, posted a photo basically of a gamer not laying back in his chair anymore, but instead sitting forward and getting in the zone. And that alone has pushed GameStop back to over 70% up for the day. At one point, we were actually trading around $38. And so what I want to do in this video is talk about, first of all, risk management, because we are talking about a very, very volatile security here. And the second thing that we're going to talk about is, could we see GameStop actually push back up to 70, 80, 90 dollars? And fundamentally, is the same exact landscape happening now that was happening back when Melvin Capital went under and all of that craziness happened? Funny enough, they actually used a clip from our YouTube channel on a GameStop documentary. I forget the name of it. It's on Hulu. But when price was trading up around $100 last time, I was saying that there's no way it was going to end up holding there. And they took me entirely out of context. And the thing that I want you to understand anytime we're trading or anytime we're investing is that you need to understand what is fundamentally going to push a stock continued up or a continued sell-off. There are a lot of fundamental aspects. Now, the first thing with GameStop, the whole reason that we got this massive push up here is because of short sellers and short sellers having to cover. This is what's known as a short squeeze. The short squeeze occurs basically when you have a lot of short sellers who are betting against the stock. The way that a short seller makes money, let's just look at this example, this 2 weeks here back in 2021, is that they look to go short at a price that they obviously think the stock is going to continue to sell off. We could go ahead and look to enter short. And then from here, the way that we actually make money is if the stock continues to sell off. Let's just say that we ended up shorting 100 shares and the stock went from our entry price of $100 down to our target price of $60. Well, we are going to keep the spread between 100 and 60. And so basically, as we're selling these shares short to the market, we're borrowing against and selling them out there. When we cover them or we buy the position back, we get to keep that spread. So in this case, $40 per share. Now the inverse actually happens as well. And this is how you lose money. So let's say that we go short on GameStop here at $100. And from that point, the price goes all the way up to 120. Well, in this case, I'm going to end up losing the spread from where I ended up selling the shares short to where I bought them back or covered, which is $20. Now that's the basis of shorting, but what happened in GameStop and AMC and a couple of those other companies back in 2021 was that there was so much shorts that there was actually more short sellers than there were actual shares on the market. And the thing that you have to remember about short selling is you are borrowing this position. So remember, we are selling shares short and we are borrowing those shares from where? From our broker. So when we are borrowing shares from the broker, their money is at risk as well. Of course, they're going to do what's called a margin call, which is they're going to close your position out and you're going to lose money before they lose a dime. But you still have to remember, their money is on the line. If some crazy short squeeze happened like GameStop did, the bank could actually end up losing money as well. And so what happens is you get a margin call. And what happened in 2021 was when we were seeing prices down here at $10, we start to see a breakout. And now all of these hedge funds who have shorts like Melvin Capital, etc., they are all short heavily on this company. And so as price gets up to 20, up to 30, up to 40, and eventually up to 50, the banks are calling these hedge funds every day like, hey, you have hundreds of millions of dollars short. Here's what we're going to go over in a moment, which is there's actually more shares short than there are shares in existence. And a lot of people are like, how is that possible? We're going to explain that, but there's more short shares than there are even shares in existence, and this is a problem. And broker or bank that's loaning that company the money will go ahead and close the position on their behalf to protect their capital, which, like we said earlier, is called a margin call. From this point, the only way to cover your position or to close your position is to raise the price of what you're willing to pay for this. So if price is trading at $10 and then this company has to cover their position, now they're going to offer $20. This is how a stock goes up in value. We are constantly seeing an auction in which, in order for the price to continue to go up, somebody has to buy it out from under you. And so in this case, if there are no sellers, then you have to bid it higher, back up to 20. If there are still no sellers, it could go back up to 25. And what was so crazy about GameStop, and this is the most important thing that you have to understand when we're looking at the past, and then we're going to frame that up to the present, is that there was 450% short shares than there actually was in existence. And in my opinion, that should be illegal. But basically, because you're borrowing these shares, you don't actually have to own them. When all of these banks had to cover, there was nobody selling. And this is where the whole GameStop hold meme came from, because in theory, what Roaring Kitty was right about was that if all of us do not sell your positions, then they have to continue to bid it higher and higher. It is the only way for them to cover their trade is to buy shares. But if there are no shares, they can't cover their trade, and they will continue to bid it higher and higher and higher. And this was how we were able to see the parabolic move on GameStop, because we ended up having a massive push within a single week, 1,000% nearly, up to $120. But you have to understand, at some point, if you got in down here at 10 and you're up 1,000%, screw holding, you're going to just start selling. And so eventually we had enough retail sell their positions to allow those companies to actually cover their shorts, which is why we ended up seeing GameStop crater all the way back down to $10. Because here's the deal. If there is not that type of shorting situation or that type of environment where there is more shorts than there are shares in existence, and in this case, 4 times the amount of shares short than there are shares in existence, that is how a parabolic squeeze happens. A parabolic squeeze cannot happen if there's no short squeeze in play, or at least not enough short people in play. And if we're looking at short interest right now, it's sitting at 24% versus 140% even back in 2021. And so this is why, in my personal opinion, I don't think the GameStop is going to see a push back up to $100. The reason that we saw that move back up to 100 back then, like we said, is because big money got stuck with their pants around their ankles. I don't think that that is ever going to probably happen again. And if it does, then we need to see the same exact environment. The only thing that's going to continue to push this stock up is not going to be a short interest bubble or break. It's going to be if the company can actually fundamentally get their shit together, and that could propel the company potentially back up to $100. But I don't think that some short squeeze is going to be that catalyst to move it back up to 100. But let me know if you think I'm right. Let me know if you think I'm wrong. Comment down below. And thank you guys always for all the support. I'll see you next time.